This video is to help you understand the oncoming impact of the social investing revolution and how you can position to take full advantage of this dynasty wealth building opportunity. Dynasty Wealth Investing is itself a social investing community and has identified various other rapidly growing social investing communities within the vertical. Social investing is the sequel to social media. Social media was the previous dynasty wealth building industry that emerged in 2003. Between 2003 and December 31, 2014, the social media industry, including LinkedIn, Facebook, Yelp, and Twitter, built an aggregate of $274 billion of dynasty wealth. During that time, the first $500,000 originally invested in Facebook appreciated to $21 billion. Social investing evolved from investing and investment banking, which began in the 1840s. Investing began due to necessity being the mother of invention. Prior to the 1840s, individuals only saved via bank deposits. When the banks refused to finance the railroads, community leaders urged citizens to remove monies from the banks to finance the railroads directly. Railroad bonds and stocks were the first ever investments that were made by pioneer U.S. individual investors. Henry Lehman immigrated to the U.S. in 1844 and opened a cotton exchange for farmers. After he convinced the farmers to provide the cash to build a railroad to transport their cotton crops, he and his two brothers established the Lehman Brothers Investment Bank in 1850. The railroads, enabling goods and people to be transported safely and efficiently over land, transformed the U.S. and world economies from agricultural to industrial. The Lehman Brothers Investment Bank and early investors went on to fund many new inventions and companies that produced dynasty wealth between 1880 and 1980, including GE, AT&T, Ford Motor, Boeing, Intel, and Apple. As investing became very popular, the result was the Roaring Twenties. It was a period that was marred by rampant securities fraud. It culminated with the stock market crash of 1929 and started the Great Depression. In 1933, the U.S. Securities and Exchange Commission, or SEC, was formed. The first rules that the SEC implemented banned businesses from advertising to raise capital. The SEC also banned businesses from raising capital directly from the masses or the crowd. Due to the 2008 crash, the biggest since 1929, the Dodd-Frank Act is signed into law in 2010. The Dodd-Frank Act significantly increases a broker's liability for making investment recommendations and significantly increases the SEC's ability to enforce. Because of these constricting forces, brokers and their ecosystems, which had funded new companies and inventions since 1933, are disintegrating. The passage of the Jobs Act in 2012 gave hope for new inventions and companies to obtain financing via crowdfunding. The SEC lifted the 80-year-old advertising ban, and the ban prohibiting the masses or the crowd from investing is anticipated to be lifted in 2015. It is anticipated that most of the world's countries will follow the lead and approve online crowdfunding once the U.S. government and its SEC lifts the final crowdfunding ban. The growth and number of crowdfunding participants from 2015 to 2019 is projected to dwarf the web during its similar 1996 to 2000 heady growth period. From 1996 to 2000, web users increased from 16 million to 360 million. The number of global crowdfunding participants is projected to grow from less than 100 million at the start of 2015 to over 4 billion by 2019. To reduce fraud significantly, the U.S. government and the governments of all other countries will require that all crowdfunding be conducted via a government-regulated online portal. The portals will act somewhat like an escrow agent or bank. Their primary purpose is to release the funds to a business only after the entire sum that the business is seeking is raised from the crowd. The SEC will lift its crowdfunding ban under certain conditions. One of the conditions or caveats that the SEC has for lifting its final ban in 2015 is that online portals cannot curate their listings, or more simply put, they cannot recommend any of their listings above others on their portal. The inability for portals to recommend, rate, or rank their listings will make it very difficult for the masses to invest. Since there could potentially be hundreds of thousands of companies and inventions listed on funding portals, the masses or the crowd will need direction and guidance. Because of portal censorship, social investing communities are now emerging to help their investor members make informed choices. The communities have experienced leaders who advise and educate the investor members about companies to invest in. Some of the communities recommend, rate, and rank the deals that they follow, and provide ongoing research coverage on the companies that the members invest into. This emerging social investing industry is the sequel to the social media industry that emerged in 2003. It's a natural phenomenon, since individual investors want to align themselves with those who have experience and an affinity to invest in the same companies. The communities also have leaders who can assist to provide insight and recommendations. Individual members of unregulated social or niche investing communities invest into companies in which they have an affinity. Credible leaders of social investing communities must emerge to make recommendations and lead a community's members. With the emergence of social investing communities, investing has gone back to its mid-1800s Lehman Brothers and railroad roots. The research report, Crowdfunding Must Get Back to Its Roots, which is about the emerging social investing industry, was written by Michael Markowski, Dynasty Wealth's Director of Research. It's available at dynastywealth.com. 3 of Dynasty Wealth's member companies are social investing communities. 2 of them are positioned to become the Facebook and LinkedIn of the social investing industry. Dynasty Wealth Investing is projecting that it will have 10 social investing companies within its community by year-end 2015. This number is quite realistic when you consider by comparison that the social media revolution has already generated over 500 global companies. History will record the decade ending 2020 as the best ever for an investor to create dynasty wealth.